Across the country, some Americans are going back to their jobs, but millions are looking for new ones. So how has the new Corona economy changed the game for older workers? And are there new challenges? Are there new opportunities? What questions have yet to be answered? It's that time again, time to tune out the hype and focus on the facts. Facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
Joining me right now is Sound Income Strategies founder and CEO David Scranton.
They've created a new type of inflation, and although markets have always been an emotional place, they seem to be even more of an emotional place these days.
Jeffrey Small, market watcher, is with me.
Stock market dynamic is getting ready to significantly change.
So let's bring in our co-host, Jeff Small, president of Arbor Financial Services, and also the brand ambassador for the Retirement Income Store. As quarantines and social distancing rules continue to be lifted or altered, many furloughed workers are going back to work. They're the lucky ones. Millions of others were laid off during the pandemic. Now, although older workers statistically were less likely to be let go during the pandemic, those that were may now have to dramatically alter their plans and strategies for retirement. With more older Americans staying in the workforce or finding new jobs in retirement more now than ever before, the pandemic has raised new questions for them as well. We'll explore some of those questions right here on today's show. We'll also talk about what the employment picture looks like now as states are moving forward with reopening. We'll look at potential new challenges and opportunities facing older workers, as well as those who'd hope to explore new job opportunities during retirement. We'll talk about what's happening in the financial markets with one of our favorite guests, economist and businessman Mohamed El-Erian. We'll also get insights, of course, from my co-host, Jeff Small. But before we bring out Jeff, let's take a closer look at how the coronavirus crisis has impacted our employment picture here in the United States. As you probably know, June began with a bit of surprising good news about jobs. While most economists expected another big increase in unemployment rates from April, it actually decreased. That's encouraging, given the scope of the damage COVID-19 has caused to the American workforce. In just 11 weeks, the pandemic forced more than 46 million workers into unemployment. Another 623,000 people applied for jobless benefits under the new temporary pandemic unemployment assistance program, which was created for people who are not eligible for traditional unemployment benefits. The Bureau of Labor Statistics put the official unemployment figure at just under 15%. Many analysts agree the reality is as much closer to 20%. Even Treasury Secretary Steve Mnuchin admitted as much. By comparison, the unemployment rate during the Great Recession peaked at about 10%. Now, while May's surprise decrease in jobless numbers was good news, I believe jobless figures are likely to ebb and flow for the rest of the year. And I pointed this out on last week's show. One reason is that many businesses have to continue operating at limited capacity for a while, particularly places like bars and restaurants that often rely heavily on summer business and on tourists. Some won't make it, which means workers recently hired back could be laid off again. In addition, though, federal relief efforts like the Paycheck Protection Program have expiration dates currently set for this year. Once the relief runs out, businesses may find themselves in dire straits again unless more federal aid is approved. Fortunately, that's possible. Congress has already approved an additional $3 trillion in aid, at least on the House side, but it's unclear whether the Senate will also approve it. However, even if that happens, keep in mind that a resurgence in coronavirus cases could also severely disrupt the comeback of this jobs market. It could also be disrupted to varying degrees by violence and social unrest, as we've seen in recent weeks, if that ever should continue or get worse. As for the impact of the pandemic, specifically on older workers, I've noted already that older workers are less likely to have been laid off than younger ones. But those who have lost their jobs may be facing many new challenges and questions around retirement. We'll talk more about that coming up in just a bit. Now it's time to welcome my good friend and co-host, Jeff Small. Jeff is president of Arbor Financial Services, a retirement income store in Melbourne, Florida. He's also our very own brand ambassador for the retirement income store, as well as Amazon best-selling author of the book, Turning Financial Planning Right Side Up. Jeff, you know, we got to shorten your intro. I know you've got all these credentials and so on, but we're not going to have any time for the show. If you write one more book or do one more thing, the intro is going to get longer. We're not going to have time for the show. Come on, help me out here, pal.
I know. I'm sure the people are kind of tired of hearing it, Dave. I think we got to come up with a new lingo here for how you're going to just bring me in there. You know, you could be the Lone Ranger financially, and I could be your Tonto. How's that?
Yeah, or Batman and Robin, sure, why not? I'm sure you look wonderful in tights, just like Robin did. But that's another story for another day. Unemployment. So, since last time we spoke, this unemployment report came out. And Jeff, it's weird because the markets were so surprised on Friday and then into Monday because the unemployment rate actually went down, not up. Now, what surprised me was that economists were actually expecting the unemployment rate to get a lot worse. And I guess I was surprised by that because I figured that with the country starting to reopen, sure, there'd be some new people filing for unemployment, but there'd be at least as many people going back to work. So I kind of expected it to stay close to where it had been. So to me, the real surprise was why economists were so negative about it.
Well, you know, Dave, I think you're going to be shocked about my thoughts on this, but I think the PPP, the small business loans that came across, artificially kept unemployment at bay at this time. And when the PPP finally runs out, we're going to see the real numbers. But there's something worse than the unemployment of 42 million people right now, Dave, and that is there's a wave going on in corporate America where executives are being furloughed, not laid off, but furloughed for 22 weeks with a 10% pay decrease, or 52 weeks, you know, where they're only working 4 days a week with a 10% pay decrease. And if they don't take the furlough options, what happens is they have a chance of being laid off potentially if they don't agree to the furlough options. And so there's a huge wave of that going on. That concerns me more than the positive unemployment numbers that we had, and that being just a head fake from the PPP. So there are some undertones there, some undercurrents that we can't measure at this time.
Well, and furlough is kind of, in some companies, furlough is kind of like, you know, the writings on the wall, that furlough is a euphemism. It's a way that, you're right, they can go ahead and get the PPP money, see how it goes. But what they're basically saying is, you know, we're not so optimistic to keep people here. So you're right, I'm wondering to see what that does to the real unemployment figures, which of course is, you know, what we're talking about today on the show.
Well, it's too early to tell, but I know, big corporations are projecting a year down the line here with these furloughs. Look, if you come back, expect a pay cut of between 10 and 15%. Yeah. And so corporations are bracing themselves for the economic shock that is yet to come.
Yeah, and that's not even like a friend of mine. I've got some friends that, because I'm a pilot, of course, I have some friends that fly for some of the major airlines, and a couple of them have actually reached out to me and say, hey, keep your eyes open for opportunities, because I'm not sure I'm going to get called back if I don't have enough seniority. Let's talk about the markets. You know, I know we're anxious to get our good friend Mohamed El-Erian on today because he's going to be our tiebreaker for our ongoing feud we've had. I think this is week number 4 now. And I think he's going to side with me because Mohamed's a bond guy. He's a little more conservative. He's less of a stock market cheerleader. But, you know, you have to admit, you had to even be surprised. When the news came out, again, there was an overinflated estimate by economists of unemployment. So the news came out significantly better than that. But still, unemployment, only got better by 1%. It was very bad, and now it just got slightly less bad. So even you were shocked, I'm sure, that on Friday and last Monday that the markets went up as much as they did, just because things got a little bit less bad.
Well, sure, but I mean, the market's pricing in a very quick recovery because we had a very quick drop, but it was mandated. It wasn't based on economics, Dave. We're up 40% from the lows. This is craziness. So the market's really frothy. Individual investors have to be incredibly cautious today because they're the ones that are going to get caught in the crossfire when the market decides to turn and go the opposite direction. And it will turn once economic reality sets in.
Okay. All right, so you're starting to change course now. I think after the gain we've seen over the last week or so, you're looking at it now and saying, okay, before you said, I get it, I get why it's going up and so on, it might go up further, but I think now you're saying, okay, I get why it's going up, but I think it's going to run out of steam right now. Is that kind of what I'm hearing you say? At least soften your sentiment a bit?
Well, I think, Dave, only 20% of all money managers this year have made money. Only 20%. We are at the market top. The market is at a top, 3250 max, until after we get through the worst of the bad news, which is coming very soon.
Yeah, well, and I agree at this point, there's a lot of risk priced in, and those who were willing to take the risk and financially able to take the risk back in March were able to get in at the bottom, and they've seen a great recovery. But if you've missed out on it, we talk about FOMO and everything, fear of missing out. If you missed out on it, for at least for most of our income generation members, now is probably not the time to start piling in at the 11th hour. And there's still a lot of cash sitting on the sidelines. You've heard some of those statistics about how much cash right now the average investor has that hasn't gotten invested, that they're looking at the news and saying, what do I do now? I'm sitting at cash. I've missed this run-up.
Well, I think that's been a dilemma for many, many folks. A lot of people are sitting on the sidelines saying, what do I do? Or I'm partially invested. And so the only thing that I can say to the pro or the con of what we've discussed so far is that we're sitting in this environment where we have infinity easing by the Fed. They've opened up the checkbook, and that supported these market valuations. That is why the market is where it's at right now.
Mm-hmm. So now, a quick commercial break, and when we come back, in an artificial drum roll, our tiebreaker. We'll be back with our guest, Mohamed El-Erian, who will be our tiebreaker between Dave Scranton and Jeff Small over the last few weeks about whether or not this market actually makes any sense. So stay with us. We'll be right back in a moment, coming up on the income generation. We'll be right back. I'm David Scranton. As we reopen the economy, a renaissance has begun in the world of investing. If you or your advisor are not prepared for the new corona economy, you could be left behind. You don't have to cross your fingers and toes hoping for growth in this unpredictable stock market. There is a more conservative way, and that is to invest for income without all the stock market risk.
Call the Retirement Income Store today at 888-888-4176 for your free retirement income kit. Call 888-888-4176 now.
For behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow the Income Generation Show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes.
According to statistics, people aged 55 and older make up about a quarter of today's labor force. So far fewer of them, compared to younger workers, have experienced job loss due to coronavirus pandemic. Typically, older workers have more seniority in the workplace, and because of that, they're usually better protected when a recession hits and companies start laying people off. The bad news, however, is that when older workers are let go, their unemployment duration is typically very long, sometimes permanent. According to figures from the Urban Institute, people 62 and older were laid off during the Great Recession, were much less likely than younger workers to ever get another job. And that created another trend, which we may see repeated by the end of this current crisis. According to the Center for Retirement Research at Boston College, in 2008 and 2009, there was a huge spike in the number of people claiming Social Security benefits early. Now, obviously, that meant many people chose to take a smaller check for the rest of their lives rather than spend months or possibly years looking for another job. The Retirement Research Center had said it expects another big surge in early benefit claims this year due to the pandemic. For many Americans, Social Security is one of the biggest items on your balance sheet and one of your most important sources of retirement income. So the decision to take it early rather than at age 70, when you can get greater benefits, is a big one. Of course, the earlier you take it, the lower your benefits will be. However, as I also point out frequently, a variety of factors need to be considered when determining the best time to take your benefits. It's not just about your age. Even if you do feel compelled to take your benefits early due to job loss or some other issue, you may still have options that could boost your lifetime benefits. That's why coordinating Social Security with your overall financial strategy is so incredibly important. And in my experience, it's best done with the help of a qualified advisor who specializes in retirement income. So even if the coronavirus pandemic hasn't affected your plans or your goals for how you're going to take Social Security, it definitely has affected your retirement strategy in some way. Why? Because of its impact on financial markets, as well as on some of the federal rules and guidelines for IRAs. It has also created plenty of additional uncertainty. And with that in mind, if you haven't met with an advisor yet to review your strategy, I'd recommend doing so sooner rather than later. Keeping track of all the uncertainty and the ever-widening disconnect between the economy and the financial markets is going to be an ongoing challenge. Now it's time to bring in my co-host Jeff Small, along with our special guest and friend, Chief Economic Advisor of Allianz and New York Times bestselling author, Mohamed El-Erian. Mohamed, thanks so much for being back here with us.
Thank you for having me.
So it's interesting. 2 months ago was when we spoke last right here on the same air. And you were being a little ambivalent as to whether you thought the market would have another major pullback or would run up. But you advised people to be cautious, to enter the market cautiously with the most conservative holdings. So are you even surprised with the level to which this stock market has recovered over the last 2 months?
I am, but it's understandable. First, the up in quality trade that I recommended 2 months ago actually outperformed the market for most of the last 2 months. So if you look at the names with a strong balance sheet, good management, positive cash flow, and on the sunny side, they did very well. What we've seen recently and has really powered this market up is the rotation trade. And that rotation trade basically has meant that people feel now confident investing in the names that have lagged. Airlines, hospitality. And it shows you that the market is comfortable with the win-win notion. You win by betting on a recovery, but you also win if it doesn't materialize because the central banks have shown over and over again their willingness to support this market. And that is now deeply ingrained in the conditioning of investors.
Got it. So that's the market. I get that. But how about the economy? As an economist, I have to ask you, it seems hard for me to believe, at least, that the economy at the end of 2020 will get anywhere near to the levels it was back at the end of 2019.
That's absolutely right. And I hope we get there by the end of 2021. It's what's called the checkmark recovery. You come down very suddenly and then you start going up, but very gradually. And the recovery is long and the recovery doesn't allow you to recapture. Look, David, the numbers are still horrible and they'll continue to be horrible for most of the second quarter. We're going to be looking at the GDP expansion at this contraction of 30%, if not above that. Sure. We're going to be seeing unemployment rates above 20%. So yes, the real economy has been hit hard. And what a lot of us are spending time on is not just when will the recovery occur, but what are the long-term scars? Because you can do something about them now if you can identify them early.
Sure. Jeff, I know you've got some things that you want to ask Mohamed.
There's a million things I'd like to ask Mohamed, but I got to tell you, what great refreshing remarks, Mohamed, that you're sharing with us, and it has been quite the recovery so far. I guess the biggest benefactor of this rising market and this checkmark snapback that we've had really is the NASDAQ. We got 38% of the NASDAQ is at all-time highs. We hit a high here yesterday in the NASDAQ. It's crazy what's happening. Can you shed some light on why the NASDAQ is the COVID-19 winner in the market right now?
So Jeff, ironically, the NASDAQ has a lot of the conservative names that I like. So as I said, what are the conservative names? Strong balance sheet. So think of Microsoft, think of Alphabet, think of different companies. They have a lot of cash. They're generating cash all the time. And you want to be cash rich. Investors are comfortable with that. They also happen to be on the sunny side of the migration from physical to virtual. And I think there's now more understanding, Jeff, that that migration is not going to be fully reversed. So these companies benefit not only during the unsettling journey, but they benefit in the new destination. And that's why the NASDAQ is doing really well. The real test is going to be, do investors continue to embrace the rotation trade? Do they now feel comfortable betting on cyclical, betting on the old established industries? That's a tougher proposition. Let's hope it continues, but that's a tougher proposition given the reality of the economy.
Well, when is the reality of the economy going to be priced into the market? Because it looks like the market is pricing itself out 12, 13 months at this current valuation. When are those two lines going to actually become one, Mohamed?
When central banks get out of the way. The reason why we've had this massive wedge, and I can take you to parts of the market, high yield, for example, where we have seen an amazing compression of default likely names. Think about that. Default likely names are coming down. Any company can issue and reissue. It's the central banks. The Fed did something that, Jeff, honestly, not just surprised me, but disappointed me, which is, it's one thing for them to support money market funds. It's not also supporting the treasury market, supporting liquidity, even supporting investment grade names. But they went into high yield. They started buying default likely names. In fact, they owned the NASDAQ, they owned the high yield index, which means they owned JCPenney, Neiman Marcus, and Hertz, all of which are in bankruptcy procedures. And what that has told the market is that the Fed is willing to take on default risk. But what's the next stage in the capital structure? Equities.
But yeah, the next stage, Mohamed, is they start buying equities. And at that point, that disconnect just gets wider and wider and wider, which is absolutely incredible. But we can take a quick commercial break. So stay with us. We'll be back here in a moment with much more in terms of words of wisdom from our good friend, Mohamed El-Erian. We'll be right back. Hi, I'm David Scranton. As we reopen America during these difficult times, we're all practicing social distancing. But at the Retirement Income Store, we're also practicing stock market distancing. You don't have to cross your fingers and toes hoping for growth in this unpredictable stock market. There is a more conservative way, and that is to invest for income without all the stock market risk.
Call the Retirement Income Store today at 888-888-4176 for your free retirement income kit. Call 888-888-4176 now.
If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation, again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. In addition to more Americans working well into retirement, many others are starting second careers, or at least working part-time after they retire. For many, a job provides extra income for fun things. For others, it's a way to keep mentally and physically active. For most people, it's a little bit of both. But if your retirement plan included working, will you still be able to in this new corona economy? And the answer, hopefully, is yes. Although the kind of job you take may end up being a little bit different from what you planned on before the pandemic. You know, although the crisis has been devastating for many different types of companies and industries, other businesses have actually grown and have actually prospered as a result of this pandemic. And in addition to that, many are likely to continue growing. Why? Because they suit what we call the new normal that's taking shape as the economy reopens. As our guest Mohamed El-Erian put it, these are companies that benefit not only from the unsettling journey, but also from the new destination. For example, telemarketing and telecommunications companies are hiring. Warehouse management and food delivery jobs are available. There is also rising demand in logistics and supply industries, finance, pharma, and for non-critical healthcare workers, among others. So in addition to that, many entrepreneurs have used this pandemic as inspiration to launch businesses that fill a new need. And of course, this creates employment opportunities for people of all ages, including older folks. For example, a franchise company called Seniors Helping Seniors is actually looking to hire 1,500 new workers over the age of 65. Seniors Helping Seniors actually directly matches older caregivers with senior citizens who need various levels of in-home health, a need that emerged from the pandemic's impact on traditional nursing homes. The company's founder, Daniel Jan, said that there is now a perception that facility-based care is less safe, and that he launched his business as an alternative. That's just one example. The bottom line is this: as the new corona economy takes shape, older workers who plan to keep working as part of their retirement can probably stick to their plan. However, they may need to alter it a bit to suit this thing called the new normal. Now let's bring back my co-host Jeff Small, along with our good friend and special guest, Chief Economic Advisor at Allianz and New York Times bestselling author, Mohamed El-Erian. So, Mohamed, you know, we did a whole show last week, Jeff and I did, about whether it's going to be U-shaped, V-shaped, W-shaped, L-shaped, and now you gave us the dreaded checkmark shape, at least on the economy, with obviously what's happening is a V-shape on the stock market. But do you think that with this step that you said disappointed you, with the Federal Reserve now getting into junk bonds, do you think that those two lines will ever come together, as Jeff asked, or do you think we could be in a time now of a new norm with really two disparate sets of books, almost, if you will, kind of like the mafia? You know, you got two books. You got the book for the economy, and then the book for the stock market, which is, you know, supposed to be reflecting the economy, but maybe no longer will.
So I can only think of two ways these lines come together: a good way and a bad way. A good way is that the economy picks up steam much faster and we validate elevated asset prices. The bad way is either the Fed exits suddenly and the markets basically hit a massive air pocket, or alternatively, we get massive bankruptcies. Because the one thing the Fed cannot protect against is capital impairments, right? What you're going to get is the two lines merging slowly, both from above and from below. And where policy comes in, David, importantly, is that it can accelerate the convergence from below. It can accelerate the economic recovery. David, you heard me say this over and over again. It's not just enough to win the war against a global depression. We have to secure a piece of high and inclusive growth.
Absolutely. You know, it's funny, I end up disagreeing with so many people with things. I disagree with Jeff on some things. And one of the things I disagreed with you on, I want to see if you changed even just a little bit from 2 months ago, is I think in time we are going to go to negative interest rates by the Fed. And you said, well, I really don't think that's going to happen. Have you, now that they're buying junk bonds, have you gotten a little more liberal on that thinking perhaps, or do you still feel like it probably won't happen?
So if you're asking me what should happen, that's an easy answer. They shouldn't go negative.
Of course.
If you ask me what will happen, I can no longer predict this Fed. This Fed has done things that puzzle me. So I can no longer predict that Fed. So I think you were ahead of me as usual in saying, look, keep an open mind. And this Fed has proven that it's willing to do things. But the evidence, David, is pretty convincing that you better have really good reasons to do it, because the unintended consequences are large and getting out is almost impossible. It's
That's
like
right.
no exit. It's no exit. Once
That's
you're
right.
in,
Yep. Again, I don't know why I'm talking about the mafia so much today, but it's kind of like the mafia. You know, you can get in, but you can't get out. So I agree completely, and thank you for your humility, which I love so very much as usual, Mohamed. Jeff?
All right, Mohamed. So Dave and I have had a running feud the last 3 or 4 shows. I've been bullish, he's been bearish. And so you're going to have to break the tie for us here. We're counting on you to not let us down. But I got money on you that you're going to lean in my direction. The market's going to be a little more bullish here. As long as we don't have a second wave, animal spirits are alive, steepening yield curve, dollar is falling, market is getting hotter. You know, like you said, cash balance sheets are hot right now. There's a rotation in and out of the COVID stocks.
Hold on, Jeff. This is what the attorneys will call leading the witness. No leading the witness. Let the man answer, for goodness sake.
Okay. I'm sorry. Go ahead.
So you said as long as we don't get an increased infection rate. I mean, that's important. Look, I'm gonna say something that sounds very contrary, and I'm really glad I'm not managing other people's money, because I would have enormous difficulty managing other people's money. I think in the short term, the market goes higher, but I am not comfortable participating in this rally, because you are basically betting on central bank moral hazard, and that's something I don't like doing. So will the market go higher? Probably, but it's going to go higher for the wrong reasons.
Interesting. And I guess that's been my thought too, as Jeff and I have had this disagreement, is that my approach has been, even if you're right, Jeff, at the end of the day, do our clients who are very conservative, who are all over age 55 years old, do they really want to participate in something that's essentially artificially levitating without any real fundamental support, or at least not enough fundamental support? So we got about 1 minute left. So I asked you this last time, I'm going to ask you again. Talk to our income generation members, those viewers and listeners who are over age 55. What's your best advice for them at a time like this?
My best advice for them is be careful of what you're being asked to do. So by going ever lower on interest rates, and by basically wants you to take equity risk. That's what they want you to do. Not because it's in your interest necessarily, but because that's how they hope to get the economy to recover. So if you do that, understand why it is you're being asked to play this game, and make sure you can afford a mistake, because you are entering into deeper and deeper default risk.
Well, that's something that you and Jeff and I all agree with, for sure. So I have to ask you, Mohamed, seriously, over the last 2 months, since last time we've seen you, your hair seems to have gotten a little grayer. Is that in part because of what's going on in the economy and the stock market right now?
So I'm getting older. That's one. Two, my hair is longer than usual.
Yes, I know.
That's two. And three is I've been waking up at 2:30 every morning. So I'm going to get grayer and grayer. I did have a beard for a few days, and the family vetoed it.
They vetoed. That's great. Well, all I could say is, for your sake and others, but for your sake also, I hope we don't have another uptick in infections, because 2 months from now we might have you back on the show. You might be totally white-haired. So we'll look forward to seeing what you're looking like in 2 more months. Mohamed, as usual, thanks so much. This has been our pleasure having you.
Thank you very much. Thank you, David. Thank you, Jeff.
And you stay with us too. We have more coming up in just a moment, right here on the Income Generation. We'll be right back.
Investing for income? The idea has grown in popularity over the last several years due to today's volatile stock market. But if you're at or near retirement age, it's no longer just how much you've saved. It's about maximizing and protecting your life savings while minimizing your risk from market ups and downs. David J. Scranton's new book, The Retirement Income Story, is here to help baby boomers face the challenges of investing in this age of economic uncertainty. Visit theretirementincomestory.com to learn more.
Welcome back to the Income Generation. I'm Dave Scranton. I'm here with my good friend and co-host, Jeff Small, president of Arbor Financial Services in Melbourne, Florida, a retirement income store. So, that was a lot of information from our good friend, Mohamed El-Erian. Jeff, your thoughts?
Well, first of all, the information he gave us was some of his brand new thoughts. I've probably watched 15 of his interviews on the other networks over the last 60 days. And it was phenomenal. But Dave, I'm going to have to bust your chops on this one. He was definitely leaning in my camp. I asked him why the NASDAQ went up, and he came out and said, those were some of my picks. So we've got the perma-bear, the corporate type mentality of bearishness, and Mohamed saying he had some picks at this time. So I win. Thank you very much.
Well, wait a minute. Not so fast there, Jeff. It sounded more like a tie to me. He kind of said, you're both right. And his picks that he was referring to is when he said start off defensively, and then as the market starts to to solidify on its way up, then you can get more aggressive. So he was talking about defensive holdings, and unfortunately it wasn't clear in our previous interview 2 months back whether it was defensive holdings from in the stock market or defensive holdings such as investment grade bonds and things like that.
Dave, this isn't football. This isn't football. There's no defense here. He said buy companies like Microsoft. You know, the strongest companies with the strongest balance sheets in the NASDAQ is what he said to buy. This isn't football, Dave. Get away from football.
I think in best case this is a tie, and I think you're just being a sore loser. But nonetheless, what else? What else, Jeff, did you hear Mohamed say that was good? You're right. He came up with some. He was talking about some different things. He has a little different view, and that's why we love Mohamed so much, because he's such a thought leader. So what have you heard new on the thought leader side that you think is going to be applicable to our income generation viewers and listeners?
I was shocked when Mohamed said he was disappointed in the Fed because the economic lines of the economy haven't crossed into market valuations. I was shocked because he was calling that from the very beginning of this pandemic and the economic meltdown that we've experienced from the inception of it. And so I think he's mad because the Fed used infinity easing to invalidate the things that he was saying. So I think he's wrong about the Fed. I think the Fed had to do all of this. I think he's incorrect.
Yeah, and that's where I think he is somewhat in my camp, because I think part of the concern is he's saying, okay, it's not surprising in retrospect, so he agrees with you that when the Fed gets involved to this extent, the market comes roaring back. But I think he agrees with me in that, unfortunately, what that does is that makes traditional stock market valuation more and more difficult, which is even difficult for mutual fund managers, you know. So I think the risk there is even for some of our viewers, some of our listeners, Jeff, that feel like they're in mutual funds. They're not picking individual stocks. They feel like they've got a professional at the helm. That it's made it harder for those professionals, those fund managers, those stock pickers, to really determine, what's live or what's Memorex, what's real or what's not, because the Fed has caused everything to artificially inflate again. And I mean, I think that's really our biggest fear right now with individual investors that are listening to us or watching us, don't you?
I really do, Dave. The Fed has set the table for the humble pie trade, which means that the small investor is going to get squeezed when all the big investors decide to take their profits. And we're left saying, well, wait a minute, I thought the market was going to keep going up. And so the markets have tops, and we're right there.
Yeah, well, we are right near the previous top for sure. It's hard to think we're going to create new record highs when there's still far more uncertainty now in the markets than there were in February. But with the Fed, I mean, who knows? Who knows if it happens or not? But like I've said just a few minutes ago, at the end of the day, I think what you, as our viewers, our listeners, have to think about is, if it is heavily Fed-induced and if it's not 100% real, then do you want to place that bet? I know for me personally, the answer is no. So Jeff, I'd like to switch gears a bit. Have you had issues right now with any of your clients or people you've spoken with that are retired or close to retirement that have lost their jobs, that maybe they're scrambling to change their retirement plans around?
I've had a lot of conversations recently, Dave, about do I take my furlough option or do I just write it out and take a chance of being laid off? That's happening all across America, as we've said earlier in the show. And so there's lots of people trying to deduct, or do I just retire early now? So everyone has to reassess their own situation at this time. But to touch on what we were discussing before, investors have to be very careful, because what they don't understand is the humble pie trade, and that means that they're going to get squeezed at the last stage or the last maybe few years or year of their working lives. And so viewers and listeners have got to pay very close attention. Now is the time to go conservative if that's you in your own situation, potentially being furloughed, let go, or, retiring early.
I want to talk with you more about that right after the break, Jeff. I think that's a really important topic for our viewers and listeners. So you stay with us. We have much more to come right here on The Income Generation. We'll be right back. Welcome back to Income Generation. I'm Dave Scranton. I'm here with my good friend and co-host, Jeff Small, who, as we decided in the last segment, needs no introduction. So, Jeff, you know, it's interesting. I've had this happen, too. I actually have a call coming up next week with a client of mine that is lost her job and now is considering taking Social Security early, is trying to figure out what to do. Even, you know, they have an annuity, for example. They're trying to figure out, gosh, should I, you know, start taking the income from the annuity? But as you know, a lot of times you start taking income from the annuity, you really can't stop it. So that's a hard decision. And these are some, you know, pensions. I have pensions from previous employers. Should I start taking those now? And the answer really depends, you know, if you're going to find another job in the short term. If you are, well, maybe we'll spend down assets from one of your accounts. If you're not, then yeah, you got to start turning on those income sources. So in the real world, I mean, how do you help clients make those decisions, which are kind of quasi-permanent decisions, but we don't have a crystal ball. We really don't know whether they're going to be able to get back to work in a different company or different industry.
Well, I think that, you know, and the listeners or the viewers have to look at their own situation and say, okay, what are my fixed expenses if I retire? What is my budget going to be? And then what is the total amount of income that I'm going to have from all the other income sources? And what they know how to do most of that, Dave, but what they don't know how to do is create income from their portfolio. And they have to find an advisor that is income centric. I think we've said that before on the show before. Do you recall us talking about that before?
Yeah, it might have been a show a couple years ago we had that conversation. I can't recall exactly. But you know, the other thing about that is if investors are growth-based, then it's hard to make the calculation I'm about to suggest in just one moment. But if they're income-based, it is. And here it is. Okay, if your portfolio is earning a 5% income stream, you can look and say, every year I defer Social Security, it goes up by 6.5%. And then after my full retirement age, it goes up by 8%. Okay. Why don't I spend down some of my investments because my Social Security income is growing faster? You can do the same thing with your pension. If I take my pension early versus on time, essentially what's the percentage increase by waiting? And decide whether it makes sense because you want to spend down the lower yielding investment. So that's the type of math that I'm going to do with this particular client next week to determine. And the answer might be some of the benefits she takes early because we don't want to deplete her investments. Other benefits like Social Security we might just delay and start to spend down some of the investments that we thought would be there longer term. That's really the conversation that I'm looking to have. And I'm sure you've had some of the conversations too with your clients, Jeff, correct?
Oh, no doubt, Dave. And clients are amazed. Even pre-clients that come in for retirement planning are amazed when we say, okay, how much are you making? How much are you contributing to your 401k? Here's how much you pay in Social Security and Medicare. Oh, by the way, your retirement income is going to be the same as you're living on now. They're shocked and shaken and said, I have no idea. Had no idea that was possible.
I love it when I could give that good news. Unfortunately, we can't do it all the time in all cases, but when we can, it's a good feeling. So we need to leave it there. We're taking another commercial break. You stay with us. We'll be right back in a moment here on the Income Generation. I'd like to thank our guest, Mohamed El-Erian, and of course my good friend and co-host, Jeff Small, for joining me today on the Income Generation. I also, of course, want to thank you, most importantly, our new and returning viewers. In the age of texting and social media, you know, everything today has an acronym, and chances are you've heard of FOMO. That's F-O-M-O. It stands for fear of missing out. In addition to hearing it, you may also be feeling it as you watch the stock market recover so rapidly from the downturn we saw in March. The fear of missing out on this recovery may just be what's preventing you from reducing your market risk. It may even have you questioning whether now might be a good time to increase your stock and mutual fund exposure, as some Wall Street pundits are suggesting. The feeling is understandable. You know, fear is a strong motivator, and no one wants to be the person who didn't take advantage of a good opportunity. It could be that the stock market does keep going strong, somehow. But the question is, based upon what? Is it real or not? Because if not, then the question becomes, are you comfortable betting on something that isn't real, especially when it comes to your life savings? Despite some mildly good news on the job front this month, and despite the fact that the country is slowly reopening once again, I would argue that what's happening with the stock market right now isn't real. Part of the recovery at the beginning sure was, but then we got way past that. and into this unreal territory, and it seems to be getting more unreal all the time. Think about it. For it to be real, you'd have to assume that Wall Street's betting on everything going right in the second half of the year. They're betting that there'll be no resurgence of the virus. They're betting on getting a vaccine very soon. They're betting growth will be strong enough in the last 2 quarters to make up for historic shrinkage in the second quarter. Lastly, they're probably betting on more help from Congress and the Fed. They're betting on all these things and more. Why? Because it's the only way that the overvalued market can make sense again without another correction. But does that make sense to you? All I can say is that for me personally, if I see an investment that depends upon the sun, the moon, and all the stars lining up in a straight line in order for it to pay off, then I'll definitely look for an alternative, especially if the cost of losing outweighs the reward of winning. The good news is that there are alternatives for reducing your risk and better ensuring you'll have reliable, sufficient income to meet your retirement goals, regardless of market conditions. Stay safe, and thanks for watching. If you're close to retirement and you really want to know how to protect and maximize your money, as you know, it's essential that you stay informed and up to date. And right here, of course, is where you can do it on the Income Generation. I'm David Scranton, and we'll see you next week.